Welcome to our weekly livestock market update. I'm Indiana news anchor reporter for Brownfield. Meghan Grebner with us again is University of Missouri Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
All right, we're going to start off on a note that's really not very positive. We've seen a slide in hog prices that has stretched pretty much 3 weeks and some change. Let's talk a little bit about what's going on there and what's driving those prices lower.
Yeah, absolutely. Boy, the story really since the 1st of July has been one of lower hog prices as we roll, and you know, we would have been easily $10 or $11 a hundred off here. So what was a pretty good situation as we were going through 2016 has become much tougher. I will say, number one, I think we have ample supplies of hogs coming to town right now, and I think folks have realized that. There's more beef supplies on the marketplace right now, so for those that want to substitute, there's a little bit of better opportunity to do that. You know, I think if you look back, though, a couple, 3 months ago, one of the things that we often talked about that we thought was positive to the hog market was what was going on in China. We saw some decent strength in terms of Chinese imports of pork products, and the U.S. did gain from some of that. And we have the Chinese with very high hog prices also then looking for product. But I think that's probably beginning to wane, and so export growth has been a little tough. And I think that's been one of the things that we've seen in the market as well. You look at things like pork bellies, and yet, you know, we look this week, we're off again. We were kind of sitting there around $1 for a period of time, and we pretty quickly have gotten down to closer to 85 cents. We'll see where we finish the week. We had pretty large freezer stocks of bellies, and folks have decided it's time to move them. So again, I think ample supplies coupled with maybe a little weaker demand has certainly changed the hog situation over the last 5 or 6 weeks.
Do we get even more nervous about this as we look at tight shackle space at the end of 2016 and the early and beginning, Q1 of 2017 even?
I think so. I think when you look at the fourth quarter, it's going to put packers in a situation where they don't have to bid very hard to keep those lines pretty full. I think packer margins are going to continue to look pretty good for the remainder of 2016. And that makes it much tougher for producers wanting to sell hogs. And again, you know, we're probably still sitting here with a few weeks in the latter part of 2016 where we're going to be really close in terms of space if not having too many hogs relative to the space that we have to hang them. So I do think it's tough. I will say trying to predict Chinese trade in pork is very difficult. Small changes there can have big effects, so perhaps we get another second round of boost at some point, but right now it's pretty hard to see too much that makes me too optimistic about where we go for the remainder of this year.
We talk about this slide in the hog market. We've seen a little bit of a setback in the cattle market as well. How do they differ, and what are we seeing maybe that isn't so concerning on the cattle side?
Yeah, so I think when you look at especially much of July and here into mid-August, it's been a situation where when I look at, for example, fed cattle, you know, we've kind of hung around $1.20 plus or minus for the most part over that period of time. That comes off of what was a slide for the early part of 2016. So it seems like we've tended to find a bottom. You know, we've been searching for that bottom for a period of time as beef supplies ramped up. So perhaps much of the decline that we needed to have take place got out of the way earlier in the year, and we've kind of found that bottom. I think you can still look at the export side of beef and find some things that have made us hit that bottom as well. You know, Australia is certainly short on beef right now. Their cattle prices are record high. I think places like Korea and Japan have needed more beef product, and the U.S. has been willing to step in when we've seen Australia short. So that growth in Asia generally for beef has been one of the positives that I think has also kept us much flatter of late on cattle prices.
One of the things that we talked about for weeks now is the fact that these lower commodity prices are helping to offset these lower livestock hog and beef prices. USDA today is expected to grow this corn crop again. Is that a good sign or a positive sign for producers when we're looking at feed cost into the future?
Potentially, we're going to get some really big yield information from USDA, and certainly the private analysts are suggesting a growing corn crop. I've seen the high end of that at 175 bushels an acre on the corn side. And I can't find anybody right now, Megan, that will tell me that the corn doesn't look good in their neck of the woods. So a 15 billion bushel corn crop does nothing but put pressure on prices, I think, as we look ahead. So if I'm growing corn, I'm not so excited about that. But the flip side is, from a livestock perspective, as we've had lower hog and cattle prices, lower feed costs actually make that bottom line not look as bad as it otherwise would be. So, in fact, I think when you look at the data from Iowa State on fair to finish returns, July is still positive, and frankly in one of the top 20% almost of that series. So it has been this ratchet down of both sides, and luckily feed costs have been moving down at about the same clip as we've seen hog prices move down, and so it has made that bottom line not look nearly as bad as I might have thought earlier.
We're going to stray off the livestock side of things for just a minute. We've seen a lot of reports recently talking about land values, cash rents. How does that all even tie back into the overall farm economy and ag economy, but also impact our livestock producers and the livestock side of things as well?
Yeah, so we certainly are changing rapidly in the other direction. You know, I remind us all the time that when we went back to 2012, 2013, 2014, we were on the other side of this situation with growing land values, growing cash rents, and it's amazing what you can pay for cash rent for corn ground when corn prices are above $6 a bushel. However, when we're seeing cash prices float below $3, it's amazing what you can't pay for cash rent on corn ground. So we are seeing that change. The data we got from USDA recently, we see U.S. crop land cash rents for 2016 that were down nearly 6% on a U.S. basis. On top of that, I looked at pasture land here for a minute, and Missouri in particular, we're down about 6% in 2016 relative to 2015. That makes cow-calf production a little more viable. So we are seeing that ramp back down in those prices. We're just getting a lot of big adjustment. You can see the financial pressure slowly growing. I think we have a lot of folks still in very good shape, but those that have been extremely aggressive in expanding, I would say, the last 10 years or so, it may be a very difficult period of time for them as we continue to see lower crop prices, lower livestock prices. And I think when you look at what can adjust, cash rents are one of the few things that we're beginning to see can adjust on the crop side of the picture to try to make that bottom line look a little better.
That was my next question, are we seeing this adjustment specifically on the cash rent side because that's where there's maybe room to volley a little bit with the other inputs being pretty fixed in your own right?
Yeah, so I think when you look at corn variable expenses, excluding land here for a minute, since 2013, we've basically been flat. And so although we went from corn prices that would have been $6 to corn prices that would have been $3, so we lost half the value, whether you're talking fertilizer cost or chemical cost or seed cost, all those things have frankly been pretty flat over the last few years. And there's only land rental rates, one of the few things that I think we can get some adjustment on. And I think you see a lot of producers who are going back to landlords to say, you know, give me some help here on cash rents. It is a mixed bag. I hear some stories where landlords who aren't really connected to production ag continue to try to hold out for higher cash rents. But a lot of folks who have been around agriculture for a long time are beginning to see the pressure that's there, and and willing to work with those folks renting that land to find some balance. But that may likely have to continue if we continue to see lower crop prices here for the foreseeable future.
Scott, we talk about figuring out things on a microeconomic basis for example, for production, cost of production per bushel opposed to per acre. Is there a way for livestock producers to better manage their profitability and look at those returns on more of a narrowed and zeroed in laser focused area?
Yeah, I will say all the time, we're going to enter a period where knowing your production cost relative to what others have is going to be extremely critical. I've never met a cow-calf producer, corn producer, you name it, who wouldn't tell me they were the low-cost producer. Yet I know the distribution of costs from top to bottom is still pretty wide in a number of these industries. And when you look at the fact that we got lower prices across the board, those that have the lowest cost are the ones that likely survive this downturn. So staying focused on that cost side of the equation, I hear all the time, we got all this volatility in prices, and frankly, it's hard for producers to manage. You and I have talked a lot about price risk management. Those tools aren't as easy as you'd like to be, but making sure that you've kept in check the cost side of that equation is something that you have control over all the time. Now, I am not up here preaching that, hey, you got to cut costs at any cost, because if we reduce chemical usage or we reduce fertilizer application, that has yield effects on the crop side. If we feed a different ration, that likely affects rate of gain. All those things that also have a negative drag, you got to be very careful about how you adjust. But I'm talking about the things that maybe it's a little easier to let creep when you have higher returns, that now we really need to buckle down, and you really need to do that comparison to your neighbor. And I'll say all the time, it's not your neighbor next door, it's not the neighbor in the next state, it's not the neighbor in the U.S., it's the neighbor in the rest of the world as well that matters at the end of the day. And sometimes that's not a very fun place to be, to talk about cost cutting and where you sit, but those that survive this downturn are going to be the ones that are very efficient.
Scott, anything else this week we should touch on before I let you go?
I think we're pretty good. We've covered most things. I'll say the export side, we continue to get reasonably good news there in general from both a beef and pork perspective. It's going to continue to be the important thing as we look ahead, as more beef and pork supplies come to the marketplace, where we move those internationally. I think it's going to be critical for the remainder of this year.
I'll take a little bit of good news to end the day. Scott, have a great Friday. We'll talk to you next week.
Thanks very much, Megan. Take care.
To have your weekly livestock update delivered directly to your email box, visit our website, brownfieldagnews.com, and subscribe there. We'll talk to you next Friday. I'm Meghan Grebner on Brownfield.